So now let me explain what's happening with this property. Another national fitness chain has purchased this other company. So the lease is up in 2.5 years, and we have to make the decision, what are we going to do with this property? So one option is this national chain, this fitness chain, keep leasing the property. If they were to do that, we would have a cash flow of about $100,000 per month, which is great. Now, we've also had many companies approach us wanting to buy this property. And as we've assessed it, the purchase price seems to be between 20 to 22 million. And that's called appreciation, from 7.2 to now 20 to 22. But it's just like the cash flow board game. We're looking at, do we want cash flow, or do we want to sell the property and have capital gains? I am the queen of cash flow. I love my cash flow. So we have another minor partner in this who is our real estate broker, our commercial broker, and he went out to look at what other possibilities could we attract for a cash flow deal. So the fitness club is one option. The other option is a company, one of the largest commercial developers in the nation. They happen to have an office in Phoenix. They've come and looked at property. They want the property. It's a prime location property. It's one of the last great corners in Phoenix, Arizona. They want this property. They're willing to do what's called a ground lease. A ground lease means they're going to rent the ground. They're going to build their own building. They're going to rent the ground, and they're going to rent it for 65 years. That's another option. And that's going to be about $1 million per year for 65 years. I like 65 million better than 22 million. Okay? So again, it goes back to the cash flow board game. Is it cash flow or is it capital gains? So we talked about a plan, and Robert and I have a plan, and this property fits right into our plan.
The plan is called the exit strategy. So all of these are plans. This is what sophisticated investors have. So we're going to exit this property long after we're gone. And we're going to be gone before the property's gone. Property will probably be here for a couple hundred more years.
So here's the plan, and this has been the plan from the beginning, is that we've decided that about 90+ % of all our cash flow, of all of our wealth, once we pass, will be donated to charity. But again, going back to cash flow versus capital gains, we don't want to give them a building to sell and then just spend the money. We still want to live on the principle of cash flow. So, for example, this property, if we do this deal at 65 years, these charities will be getting this cash flow for years and years and years to come, along with the cash flow from all our other properties as well as our businesses. So our exit plan is that every year we will donate $100 million to our chosen charities for years and years and years to come. That's the plan. That's the exit strategy.
So long after we're gone, our exit is $100 million a year to charity. So that's where Garrett comes in as an attorney again. How do we structure the exit strategy?
The exit strategy looks like this, Robert. We have the LLC still on title, but instead of you two being the owners, we have a trust be the owner of the LLC. And we transfer the ownership from the two of you to a properly formed trust, and then the trust can continue past your lifetime. So this is a great estate planning technique. Tom will talk about some of the tax advantages, but there are three key players in a trust. First, it's the grantor, Robert and Kim. Then there's a beneficiary who receives the benefits from the trust. Initially, that'll be Robert and Kim, but then the charity becomes the beneficiary. Now, the third key player is the trustee. It's a person who is paid to administer the trust. And when Robert and Kim are gone, someone else is going to be the trustee. And you have to be very careful who you line up as trustees, because there's a lot of fraud in this area. The trustees get paid. Sometimes they get paid more than the charity does. In Hawaii, there are cases where there's been fraud at the trustee level. The trust document will specify who the trustee is. And you'll probably have a provision in there where if the charity is not getting enough money, as beneficiary, they can remove the trustee.
So the trustee's job is to enforce the rules
Correct.
that we leave behind.
Right.
That's it. So when we say we don't want this property sold, we want the cash flow to continue, they cannot just go out and sell the property and do what they want. They have to follow the rules that we dictated.
Yes, the trustee's job is to follow the terms of the trust.
And it's actually, you said it was called control from the grave.
Control from the grave. You're gone. The beneficiary's receiving the money, but you're controlling this from the grave.
Love it.
So that's what we do. All our tax-free money, we just give it back to our charities. And Kim and I, we're very much environmentally oriented. We give to animals, we give to trees, we give to the oceans. That's who we give our money to as charity. The rule of charity is this: you give your money to places and organizations that are doing the work that you're not able to do because you're working. So if I wasn't working at this, I'd be saving the oceans because I love the ocean. I'd be saving trees because I love trees. And Kim would be saving animals. That's the power of giving. That's why in the cash flow game, charity is a very big part of the game. Charity is a very important part of our culture at Rich Dad. Okay? So the last thing I want to just add to this whole thing is that the exit strategy is this. I said it before. $100 million a year. That's our goal. That's our exit. That's why we play this game. That's why financial education is so important to us. We got to have a great team members like Garrett and Tom. But wait, it gets better. So Tom, what is so good about this goal?
Well, remember, the tax law is a series of incentives to do what the government wants you to do. And one of the things that government really wants to happen is charity. Public charities, charities that are doing those things that the government doesn't do and they'd like charities to do. So these charities that they're going to give to, they're going to be what we call qualified, or in the U.S. called a 501c3 charity, because it's a qualified charity. Now, when you give to a qualified charity in most countries, what happens is you get a tax deduction. Okay, so you actually get a tax deduction twice in their case. Once when you give it when you're alive, and another time it comes off of your, what we call an estate tax. So you have a death tax, right? Most countries have a death tax. And so by giving it to charity, it doesn't go to the government at all. No death tax, okay? That means that the charity gets the money, the government doesn't. So again, they're controlling who they want to have the money, and the government's good with that, okay? The government says that's a good thing. But what's great about this situation is because they planned ahead. Okay, now we actually call, in my profession, we call the death tax or the estate tax the stupid tax. Because you should not have to pay it if you plan ahead. And the wealthy all plan ahead. That's what Robert and Kim are doing here. This is all about planning. Because they're planning ahead, not only will they not have a death tax, but while they're going to get income while they live, the residual value of what they've put into this trust, this will be a charitable remainder trust, the residual value of what they're putting in that trust, they get a tax deduction today for the charity getting it down the road. So they're getting an income tax deduction and they're completely avoiding the death tax simply by setting this up ahead of time, doing the trust the right way, and they've also, frankly, protected the asset from additional lawsuits.
And that's why it pays to be generous, to be charitable, to have financial education, to have a plan, a finance plan, an asset plan, an exit plan, and know how to control your taxes. That's why the rich are getting richer, but they don't teach you this in school. So when you hear about these guys like, Joe Schmo and their foundations and all that, they give out millions of dollars. They're not stupid. They're giving that money away because if they didn't give it away, they wouldn't get the tax breaks. Is that correct?
That's right. And eventually the government would get it in the end. And this way they get to control from the grave exactly who gets it, and they get to do what they want to have done with the money instead of the government controlling it.
And so oftentimes people say, oh, when is enough enough? You know, what keeps you going? And we talk about having a worthwhile game to play. Robert and I have lots of games going in different areas, in business, in real estate, all different games. This, to me, $100 million a year to charities is a worthwhile game to play.
Thank you.